providing a stage for that type of stuff. But the comments that come up a lot are, why did I pick that fair value gap in that respective video they were commenting on? And over the years, obviously, you're seeing now there's a rhyme and reason to what I'm doing. And it's a slow drip, slowly, disseminating the information, because there's a lot of people out there repackaging my stuff. I'm not repackaging anything else. But that's the excuse that, they're trying to put out there, that I'm repackaging something else. And it's simply not the case. I want you to think about how what I just said about here. When you have a turtle soup sell off, buy side taken, and it starts to sell off, you don't need this to be a market reversal. You just need it to show these types of characteristics. The first fair value gap that forms after that, keep that on your chart. Project that forward. Think about the up to data ranges. What's the lowest one? 20 days. Keep it on your chart for 20 days. That's why this is still valuable to me. Now, by projecting that forward in the future, I'm already ahead of the curve. And I knew this level is going to be important well before your volume profile is populated on your chart, well before your Elliott wave stuff shows up on your chart. I'm in the future right here. I already know this is going to be a viable level in the future. Now I just simply have to wait for time to agree and meet with that price. What does that look like? Well, that's the high of that run. You're cherry picking this guy. If that's how you think, move along. It's okay. It's not my aim to try to convince all of you. Okay. But that's what that level is. And I want you to start collecting them on your charts. And this is why having one market and being a specialist is important, because when you ask me, what do I have written down on my little notepad? The little notepad I keep next to me. It's things like this. And because there are some things on there that I don't want to teach yet, I know thousands of questions will pop up as soon as I show you it, and I'll frustrate you because I won't answer it. I'll ignore it. I'll put you, to the side and disregard your comment. And it's meant to manage the information before I release it in book format. Okay, so it's simply allowing you to understand for free here. So now you don't need to worry about that in the book. It didn't cost you anything. You're just watching it for free here. But you're looking for the first presented fair value gap after a turtle soup sell off or sell side liquidity raid and runs higher. So having these on your chart, again, you can collect these in a workspace on TradingView or whatever your platform is, or you can be old school like me. I just simply write it down. Now, that might not be helpful to some of you because you're high tech. You want to see it, push a button, it populates on your chart, and it does everything for you automatic. And I can see the advantages of doing something like that, but I just like to know why I'm using it, where it came from. I have my hands on it. So I prefer the high touch over high tech. And that's the old dinosaur in me. I'm an old head when it comes to things like that. I'm never going to change. I'm too far gone in the game, and I don't have as many years behind me as I, or ahead of me as I do behind me. So I have to be realistic about things, right? So that's the market reaction there. Now, right away, you should know the opposite of that. It was a nice little rally all the way up in here, and overnight, here's your lows. So cast forth a vision. If it's running quickly up to that level and it proves to you it doesn't want to stay there, it starts to sell off. And then we're entering the time of day when we're looking for the opening range, 9:30 in the morning Eastern time to 10 o'clock. We're looking for that first presented fair value gap. That's that right there. Now, right away, you can see it's using it here and here. And where do you think it's drawing to? Before this even formed, before 9:30 even happened, while it's dropping down, in your mind, you're going to cast forth a vision. This is what I do. I'm looking at the market and I'm casting forth a vision. I'm waiting for a price run that creates a long, protracted down close candle. I'm waiting for that to form. I'm anticipating that to form. Because I know all of this reaction from this run here is likely to see us go all the way back down to take overnight lows. That's the draw. Now, the easiest way for you to have this on your chart or a routine is overnight lows. Just simply mark off midnight Eastern time to 7 o'clock in the morning. Whatever the lowest low there is, if it's relative equal lows, that's a loaded deal. That's where liquidity is. It's going to want to seek that if it's bearish. Not all the time, not that very day, but that's how I classify it. I'm looking for that lowest low overnight. In this case, we can see it being here. So that's a relative equal low. So you can see that that's obviously a standout. That's your sell side liquidity. We have the displacement here. So that's the first percent of fair value gap after 9:30. And the market uses it here and here. And then we start getting into this back and forth type price action. This is classic of the holiday season. Again, another reason why I'm not a fan of trading around this time. I'd rather spend the time with my family. And by the way, I hope you had a very nice Christmas. Mine was wonderful. I hope you had a safe New Year's. Hope you're not hungover right now listening to this. You should learn from that. Don't do it again. But in here, we're going to take a look at this. We're going to zoom in and deal a little bit more with this. But I want you to think about that level right there being these lows. That's the draw. So I'm casting forth a vision, or you would be casting forth a vision on how price would traverse from this first resistance fair value gap down to that low. When the majority of the run was accelerated, so half that run was real quick and sudden. And now it's a lot of give and take back and forth, reaching down into that sell side liquidity pool overnight. So we're going to focus in on that little area right there, and we're zooming in. All right, look at this guy looking at you. Yeah, I know you got to keep your eye on him. Sell side imbalance, buy side inefficiency. The market creates the fair value gap. When this candle closes, it trades up into it here, and we're anticipating price reaching lower. The market drops down, comes right back up, trades to the low of the fair value gap. That's the first position fair value gap. We do not abandon the idea it's reaching for overnight lows. You cast that vision forward. On the chart, you're expecting it's going to deliver. Until you're proven wrong and it's obvious, you keep that vision in mind, how it's reaching towards that relative equal low overnight. Every single candlestick has its place. It has its role in the plot. But not every single candlestick is a supporting actor. And it's not a leading man or a leading woman in the plot. That's the difference between what I see other people do with supply and demand, and they say that I use supply and demand, renamed it. No. That's not what this is. I'm going to show you a lot of things here tonight, and it's going to look different in the future when you start thinking this way. When you're watching price action, it's going to help you. If you're brand new, it's not going to be as helpful because you just don't have the experience having worked with the things I've been teaching for years. But the more veteran students will get more out of this lecture than someone that's new. And it's not by design. It's just that's how it is, okay? You don't know how to do everything the first time you sit down and watch it. So the market creates this run up and then starts to slowly work lower, then gyrates sideways, moves a little bit lower, gyrates sideways, and it starts looking like a very frustrating type of profile. Not volume profile, not the market profile that you guys are thinking of. It's simply how price is being held in consolidation. So when I see price doing this, I'm going to look for leading men or leading women candlesticks in the plot. The plot is this booger is going down to take those overnight lows out. Now, every one of these candlesticks in here is just like, so, just an extra in the cast. They're not even getting paid to be there. They're just happy to be a part of it. And that's what's being shown here with all these different kind of candlesticks. But what I'm looking for is I'm looking for the candlesticks that have the time in the plot to start pulling forth their best acting. They're going to bring out an Oscar-winning performance. Well, we're going to bring in time now. 950 to 1010 macro. You're familiar with that if you've been watching anything I've been teaching. The market creates this return back into the first presented fair value gap. We anticipate this acting as a premium array. It should repel price or keep it from going in the upper half here. It just comes up, just breezes to the low of it, and then says, no, I'm not interested. No thanks. And then what does it create here? What's that? That's a SIBI. So now that is a leading man or a leading woman candlestick. It's going to be impactful. So now we want a supporting actor or candle to come up and show how great of a candlestick this is by it coming up to half of its range. See that? I know this analogy is, yeah, it just came to me, honestly. I don't have it written out. It literally sounds amazing for me. If I was listening to this, I would be very, very impressed. I know I got to throw these dad jokes in all the time. So here we have the consequent encroachment of the SIBI, and then we start to see the price diving lower again. But now, look closely. We're zoomed in. We have a little bit more data on the price action, and we have two relative equal lows. What makes them relative equal? The one to the right is slightly higher than the one to the left. So this is a strong candidate for a raid on that sell side algorithmically. That's how your eye is supposed to identify it, okay? It's less likely to see that immediate run. Like, for instance, say we were looking at this low and that low. This is not a relative equal low. It's not a high probability. It can eventually trade through it, but not without at least retracing back for an inefficiency above the low. In other words, something going back to the left, either a inefficiency or a short-term high. That's why I'm teaching you and have taught you for years to look for the low to have the slightly higher low to the right. If it looks like this, chances are it's going to have a deeper retracement. It wants an efficiency premium or it wants a buy side liquidity pull. Price runs up into these lows, these highs, and fails to even get back to this old fair value gap. So it's just consolidating. Now there's a paradigm shift that takes place. When you're seeing price action doing these types of things, you're looking at all these gimmicky things like footprint, depth of market, level 2 data, volume profile, whatever it is you want to reach for, book map, heat map, whatever map. It doesn't matter. Okay. Everything is available in these open, high, low, and close candlesticks. Everything's there. But what you're waiting for is the time for them to perform. But you have to know the plot. The plot is it's running for sell side. And the sell side is determined by overnight lows. So those lows are like that big magnet. And you're casting forth a vision that you're looking for this plot to pan out with Oscar winning performances by very specific candlesticks at very specific times in the storytelling. During the macro, trades up to the low of the fair value gap. That's first presented fair value gap. And that was my dishwasher, in case you heard it. I'm not going to edit that out because it proves I'm not AI. Or am I? Price trades up to consequent encroachment during the same macro. It trades lower. No fair value gap in here except for this little tiny piece right there, which is like nothing. It's like an extra in the cast. Why is this not so important? Because we haven't even broken this low. So that right there is not important to me. If this would have broken down below that, then that would have been much more salient to the plot. But because it hasn't even taken that low out, that fair value gap is just a common gap. Why don't you use this fair value gap, ICT? See how it's starting to make sense now? Not for you newer folks because you're learning, but the folks that have been around for a long time, they're like, oh, this is starting to make sense. See that? No extra charge either. So we had the run on minor sell side liquidity there, and then we retrace back up into the range. Range. What's the range? See that price action right there? From the premium array it reacted to the new sell side low that was taken right here, that created that low and then started retracing. That is how you're defining your range. What? Let me say it again. The PD array that it sold off from, my content, my concept, that turning point, because that's not support and resistance. What is that? It's the first presented fair value gap that formed after 9:30. And it's in the direction that the plot is. Sell side is going to be the target. It's going to be the draw. So we want to see this used like it does it here. Sell off, sell off. And because it can't even get into the upper portion or even trade back to the consequent encroachment of that first presented fair value gap, it's exceedingly weak. So all this in here is making it harder for someone that doesn't understand that. So the range is this right there. Now, think for a moment. You folks that like to use volume profile, you like to look for that point of control, value area high, value area low, and look at all that and look at this. Okay. When I'm looking at this range here, it's defined simply by time and my PD arrays. There's no overlap here with volume profile. There's no overlap with anything else but what I'm showing you here. Look at the midpoint. See that right there? There's a lot of price action being offered in that same range. That equilibrium price point has to have an inefficiency. Inside that range, we can see, there you go. What's that? That's a SIBI. If I take that SIBI and extend it through, look at the magic that happens. See that? Ain't that amazing? No advantage, like I said. So by having this, I'm going to take that little range box off. We can anticipate how far that shallow run below that minor sell side is going to trade right back up. And the bodies are saying, yeah, the story is still the same. All this was a plot twist. And it's causing people that don't know what they're doing to think that it's made a short-term low and it's going to rally up. But it's only going to go up to where I say it's going to go with this fair value gap. That's the equilibrium inside of this range during time distortion. That's a lot. But the veteran students knows exactly what that implies, but now you're learning how to use it. We enter another time period where price reaches up into that old SIBI. And because I'm not trading supply and demand as the folks out there use it, I'm cutting through candles. I'm going back to that one. Why did I choose that one? Because it's in the middle of the equilibrium of that range, high and low, defined by liquidity and my PD arrays. See how that is? Now I can see right away, for someone that's brand new, this is just too much and it's complicated. And how could you possibly know? Because you haven't watched price action. You don't collect the price action and go over your chart and do these types of things. When you back test, the ideal scenario is for you to go back through price action because you have the benefit of hindsight. You can look at how price moved from one level to the next, but you want to go through every single individual candlestick and make a storyline of why it did this and why it didn't do that. And you're going to see these reoccurring phenomenon that take place in price action. They will repeat in the future. These types of things repeat over and over and over again. They may be slightly different. They may have a little bit of a character twist over here and there, but generally they're doing the same thing. They're running for inefficiency. They're running for stops. That's it. Or they're waiting during time distortion. That's what you're seeing right here. New minor sell side liquidity. After reaching up into that, it sells off. Now, the bodies come up to the high of that fair value gap there, and then we leave it and look at the bodies. They stay right at the lower quadrant of it. It's not highlighted, but you can do this on your own chart. The wick goes almost to the top, but the bodies stay in the lower half. That's the signature that you know it's getting ready to start falling. When I'm doing live candle by candle calls, when I was doing it on X, and before X was X, I did it on Twitter, and before I did that, I did it in live stream, and I did it in front of a paid premium legion of people that watch me do this stuff. And it's not something I just learned overnight. I've been doing it for a long, long time. And my students that have been with me for a long time, they're learning how to do it themselves too. And it's a transferable skill set. But these are characteristics that repeat over and over and over again that you will learn by listening, taking notes, and then looking for these things in your old data and then collecting them. Don't think just because you can't make money on that past move, it's not of any use to you, because that's how you're going to learn it. There's no other way to learn it. There's no shortcut. You have to backtest. If you don't want to backtest, go do something else. Go follow somebody that wants to give signals. If they're a good trader, go for it. But I don't think it's possible for anyone to learn how to trade without backtesting. I just don't think it's possible. Not consistently profitable. I don't think that's possible. Okay, so the minor sell side is taken here, and I want you to take a look how price, we're zoomed in again here, but moved over so you can see the ending run. This dive down in here, this last little piece of the run that takes us down into that overnight low. We had this small little gap after leaving this one. It comes up, trades into it. The bodies don't even come to the high of it. The wicks respect it. We drop down, consequent encroachment on that wick, and then we start to move lower. And we're going sideways, 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 until we get to a macro time. That's not highlighted here. You do it on your chart. At 10:50 to 11:10, it's going to displace. Where's it going to displace? First run is here, so you cast forth a vision. Time for the market to run. Where? Lower. What's the nearby sell side? There. Where's it been drawing to, and where's the original vision that you cast forth over the chart? Overnight lows. It dives down. You have long, stretched out black limousines running down to the 654 club below that low. When you see price action through this lens of creating a narrative, a plot, why it should do this, why it shouldn't do that, what candles are standing out? They're leading men or leading women candlesticks in the storyline. They're going to have a major role. And the candles that use them later on, like this over here, these are supporting actors. The supporting actor is saying, yes, this person, if it were a person, we're going to personify the candlestick. This actress is falling apart. And we're going to show that she's falling apart because we can't overtake the high of that. And we're stopping right in the middle with the bodies. And then we have more supporting actors over here with these candlesticks, only go up to half of it. So the plot's not changed. They didn't change the algorithm. Everything's the same, just the date's different. That's it. That's all it is. This here is the same thing that is. We're in a range, consolidation. This old SIBI is a reclaimed fair value gap. It's being utilized here, but notice it only starts to displace lower when we enter the macro time that supposedly doesn't exist. I see your comments, guys. And they're very amusing too, by the way. We run lower to take that low, and then we take that original overnight sell side out there. But wait, there's more. If we look at the overall run now, all this price action in here, this is how I use narrative. And then I talk about how the candles shouldn't and should do. When I'm doing live streams, when I've done this in Telegram, when I was running that, I did all these types of things to prove that I could call the candlesticks before they formed, how they were going to form. Watch this candlestick, watch that candlestick. What I'm outlining here is that skill set, how you adopt it. How do you learn how to do it like I do it? You have to create these little storylines in old price runs. And by understanding the primary factors of what makes my smart money concepts what they are, that logic behind them, one piece of the puzzle at a time. You cannot learn this quick. 5-minute trainer mentors out there, it isn't going to do it for you. It may feel like you're learning because you're being entertained. They're taking pieces of my videos. It's the real good stuff. That's not going to help you because you have to have all the supporting logic around why it's beneficial to even know it. For instance, if I were to show you a deck of cards in my hands and I fan the cards out and I say, pick a card, and you reach in, you take a card out, you think you have a free choice. You have no idea that I've forced that card on you. I know that you have the ace of spades in your hands. You think you freely chose that card. Now, By me having that force on you, I know the outcome of the effect or trick. You don't know the outcome of using that little piece of information that's being forced on you. You don't know the logic. You don't know how the trick ends. You don't know the place that little nugget of information goes in the grand scheme of things, which is my smart money concepts. But when you watch all these little shorts and all these little channels that are popping up, it's wonderful advertising for mine. I don't need to do anything, but it's not helping anyone by just simply looking at these little snippets, because you have to have the supporting logic as to why is it information that's useful? Is it useful information? When you just simply look at small little pieces of the puzzle in and of themselves, by themselves, they're not worth much at all, except for here, well, look at that. That's something to it. What do you do with it? Right. That's where all the long drawn out droning conversations